Hey, Brad Castro from GreatOptionTradingStrategies.com. Thanks for taking the time to check out this video. I appreciate and respect your time, so I'm going to try to keep the fluff to a minimum here and really focus on delivering the goods to you. So I've been publicly advocating and teaching option trading from a value investing perspective since 2008. And what I really love about options is how flexible they can be and how they can be customized to fit, more importantly, improve any investing approach. If you're a conservative investor in any sense of the word, that means boosting your returns while reducing your risk. The core strategy I teach is a customized put writing approach I call the sleep at night high yield option income strategy. At its core, that strategy does not involve owning shares, although it still very much employs and exploits fundamental value investing principles. The strategy I'm going to show you today, however, does have as its ultimate objective the acquisition of high quality stocks, but at rock bottom prices unavailable on the open market. Specifically, I'm going to lay out the framework for a cash-secured put-selling strategy designed to result in you getting steep discounts, or sweetheart deals, in 3 easy steps. And that framework is simple to understand, it requires minimal time and effort to manage, and it's still designed to produce heavily discounted stock acquisitions. But before we dive in, a couple of quick housekeeping items. First, for your convenience, and so you don't need to take any notes or have a photographic memory, there's also a special report text version of this video, which you can view, print out, or download at GreatOptionTradingStrategies.com. Now, if you want that PDF, just click on the link below, enter your email address, and I'll get you set up. And second, in the interest of time, I'm going to assume you already have a working familiarity with writing or selling cash-secured puts. But if you are new or relatively new to options, that's still okay. As we work through some examples here, things should fall into place. But you still might want to grab that Sweetheart Deal special report through the link below because the text version of this video includes a Put Writing 101 section that will get you up to speed in no time at all. And in a couple of other instances, that report does have a little more detailed information that I'm choosing to leave out here, again, in the interest of time. So, Sweetheart Deals in 3 easy steps. Now, this is important. This is not about generic put selling where you maybe get small one-time discounts, something you probably already heard 1,000 times. In fact, I'm going to show you exactly why that generic put selling approach doesn't cut it. On the contrary, with the Sweetheart Deals approach, I'm talking about really stacking the deck in your favor and acquiring high-quality stocks for the long term at a 10%, 20%, 30% or more discount. If you're already a long-term investor in world-class businesses, you're going to love this. But even if you're more trader than investor, you're still going to want to check this out. After all, trading is simply a substitute for investing because traders feel they can get better returns and get them more quickly than traditional investing offers. But maybe your perspective will change here once you see the possibilities with this approach. So let's get started. And here's how we'll do this. To keep it simple, I'm going to break this video into 4 parts. Part 1, we're going to look at why generic put selling doesn't cut it. Then we're going to look at the prerequisites for getting sweetheart deals. In part 3, we're going to drill down into those 3 easy steps for sweetheart deals. And finally, we're going to look at 2 drawbacks to the strategy, as well as 1 antidote that clears up those drawbacks. Okay, part 1, why generic put selling doesn't cut it. Okay, the boring textbook encyclopedic definition of selling a put goes something like this. You sell a put option contract at a strike price at which you wouldn't mind owning the shares and collect an upfront one-time premium cash payment. A quick example, XYZ stock is trading at $31 a share and you decide to write a 1-month put at the $30 strike for 75 cents a contract. In other words, you collect a $75 cash premium payment up front since each contract represents 100 shares of the underlying stock in exchange for your promise to buy those shares at $30 a share if the holder of the put chooses to exercise the put between now and expiration. So if the stock is still trading at or above $30 at expiration, good news. Put expires worthless, your obligation ends, you get to book the entire $75 as profit, and you're free to repeat the process if you so desire. And if the stock is trading below $30 at expiration, under the generic definition of the strategy, you will be obligated to buy the shares at $30 a share. That's true whether the stock is trading at $29.95 a share or $15 a share. Regardless of where the stock is trading, as long as it's trading below 30 and you've been assigned, your personal or adjusted cost basis on the stock equals $3,000 for the 100 shares assigned at the $30 strike price, less the $75 premium payment received, or $2,925, or on a per share basis, $29.25 per share. And I'm excluding commissions here for simplicity. Presto, generic put writing in a nutshell. And with generic put writing comes generic one-time discounts. In our example here, you acquired XYZ effectively for $29.25 a share, or at a discount to the original $31 share price it was trading at when you first entered the trade. Hey, nothing to sneeze at. Paying $29.25 a share is a lot better than paying $31 a share for the same stock. Of course, if you do get it assigned, by definition, the stock has already fallen, maybe by a lot. So you might end up paying $29.25 a share for stock that you could have gotten on the open market for, say, $28 had you simply waited a little longer. That's one major drawback to generic put selling. Those one-time discounts don't often amount to much on their own, and they don't provide a lot of protection against a declining stock. Now, that's not the only way generic put sellers attempt to get discounted stock prices. There's another technique that some use which, in theory, can provide a much steeper discount to the current share price, and that's to write or sell puts far out of the money. When you write your puts significantly below the current share price on stocks you would like to own at that price, you are in effect getting paid minimally for basically setting up a limit order on the stock at a much lower price. Say XYZ is trading at $37.50 a share, and you'd love to buy it for $30 a share or lower. So you sell a 6-month put at the $30 strike for maybe 50 cents a contract. So here's the problem, or rather 3 problems. First, 50 cents per contract, or whatever comparable small amount it turns out to be in the real world, is a pretty small return for tying up your hypothetical $3,750 of cash secured capital for 6 months. Second, how likely is it you're actually going to get assigned? In this example, the stock would have to fall more than 20% from where you entered the trade. And third, the potential discount on the acquired shares is actually still very modest when you really think about it. Yes, a $29.50 adjusted cost basis, acquiring the shares at the $30 strike price, less the 50 cent per contract of premium received at the outset of the trade. That may represent a 20% or more discount to where the stock was trading when you first entered the trade. But if the acquisition process is triggered, that means the stock has already plunged by more than 20%. So the only way you actually get a discount is if the stock falls below $30 a share, but doesn't fall below $29.50 a share. At best, this approach protects you from buying a stock near a top, but it does little else. Okay, there you go. Now you know at least as much about writing or selling puts as 95% of people in the stock market. It can be a very basic strategy, and when used appropriately, does in fact improve results, although I would argue in generally limited ways. Still, it's better than nothing, and if you are a long-term investor and you're not already incorporating short puts into your investing process, this basic approach may be something you want to take a closer look at. But an important question also arises. Isn't there anything we can do to improve the process? Isn't there something we can do to make the generic put writing strategy as a way to acquire discounted shares much more effective and without unnecessarily complicating the process? You're in luck, because there is. Part 2. The prerequisites. So what do you need in order to start getting your own sweetheart deals on high quality stocks? It's very simple. You only need 2 things. The ability to identify high quality companies that are attractively priced and a brokerage account approved for selling or writing cash secured puts. First, regarding the ability to identify quality companies, we're not talking about becoming a rigorously trained fundamental analyst. If you want to pour through a company's SEC filings, that's certainly your prerogative, but in my view, it's not necessary. On the other hand, you do have to have enough of an interest in the process, in the stock market itself, to be able to form some basic opinions about what constitutes a business with durable competitive advantages and what constitutes a reasonable, or better yet, attractive valuation. How to get sweetheart deals on high quality stocks in 3 easy steps will actually work on any stock that trades options. But keep in mind that a sweetheart deal on a low quality company or on a way overvalued stock may not remain a sweetheart deal for long. And second, regarding the brokerage account requirement, the Sweetheart Deals special report version of the video, again just click the link below to get that, goes into more detail on that front than we have time to do here. Bottom line though, getting set up to write or sell puts is pretty easy. In fact, the takeaway in summary here is that getting sweetheart deals on high quality stocks in 3 easy steps has a very low barrier to entry. Part 3, the 3 easy steps. Okay, here we go. Step 1, identify high quality, attractively valued stocks. Step 1 is pretty easy. In fact, we've already covered it. Make a list of your favorite stocks. If you could get sweetheart deals on any businesses, what businesses would you choose? And then determine a share price level you would consider to be an attractive long-term entry point for traditional long-term investors. what you imagine other serious investors without the edge you're about to employ would really start stepping in to buy. Or simply keep an eye on where your favorite stocks are trading. Are they overvalued, fairly valued, or best of all, undervalued? Or find some trusted, value-oriented resources and evaluate the cases they make regarding the quality and valuation of individual stocks. Again, there's no need to be worried about being super precise here. Fundamental analysis, like any kind of analysis, contains a fair amount of subjectivity. The big thing you want to avoid is picking a stock or situation where the prospects of a 10%, 20%, or even more of a discount may not be that big of a deal, because that discount can be quickly erased if or when the stock sells off. In other words, high growth, richly valued, momentum type stocks are not good candidates for this strategy, and neither are battleground stocks or highly cyclical stocks. At the same time, don't stress too much about this. Step 1 is simply identifying high quality stocks that are trading at reasonable or better valuations. Step 2, start writing intermediate term at or near the money cash secured puts. Good news, you can forget about technical analysis and forget about probability analysis. If you feel the underlying stock represents an attractive long-term entry point for regular long-term buy and hold investors, simply write one cash secured put for each 100 shares you would like to own, and do so at an at the money or slightly out of the money strike price. Imagine that impressive world-class business XYZ, which is currently trading at $30.25 a share, and which you consider to be an attractive entry point for other long-term investors. So write your put or puts at the $30 strike and choose an expiration 3 to 6 months away. Unlike our sleep at night high yield option income strategy, where we typically choose an expiration date somewhere in the 3-week to 45-day range so that we generate higher annualized returns while still collecting decent amounts of premium on a total dollar basis, with this strategy, we're more focused on our potential cost basis if assigned the shares than the annualized rates of return we're making in the short term. No matter what your put writing objectives are, there's always going to be the need to balance your annualized returns with how much total upfront premium you collect. That's because of the dynamics of option pricing and theta, or the differing rates of daily time decay. And that comes down to 2 factors. The farther out the expiration date is, the more total premium you'll collect up front. But the farther out the expiration date is, the lower the annualized rate at which you'll collect it. So it's always a good idea to run and evaluate the numbers yourself. But again, with the Sweeetheart deal strategy, we're less concerned with the annualized ROI on the income our trade is generating, and more concerned with getting good-sized chunks of premium to drive the potential cost basis lower. And if you are interested in the total premium versus annualized rate dynamic from selling puts, be sure to grab your copy of the Sweeetheart Deal special report version of this video down below, because I cover that in a lot more detail in the text version. Okay, step number 3, roll out the position as many times as you can. So there can basically be only 3 outcomes as you near expiration. Your short put position will either be at or near the money, where the current share price is trading at or near the strike price of your cash secured put. It can be out of the money, where the current share price is trading comfortably above the strike price of your cash secured put. Or it can be in the money, where the current share price is trading decisively below the strike price of your cash secured put. So if the stock is trading somewhere relatively close to the strike price of your short put position, above it or below it, doesn't matter, roll the position out another 3 to 6 months at the same strike price for a net credit. This is the ideal outcome. You're going to generate the highest possible net credit because you're rolling the position at or near the money, where, by definition, the highest amount of time value will be. It's as though you get to do the same trade twice, and now you will have accumulated twice as much cost basis reducing premium income. So let's say you collected $1.50 per contract for writing the XYZ $30 put 4 to 5 months out. And then, as expiration nears, the stock is still trading in that $30 neighborhood, and you roll it out another 4 to 5 months for another $1.50 per contract of premium. In total, you have now collected $3 per contract in accumulated net premium. If you were to be assigned, your cost basis would then be $27 a share, or the $30 strike price less $3 a contract in accumulated net premium. Now this is the key. Try to keep this process going for as long as possible. The more you can roll for net credits, the greater the total net premium you will collect, and the lower your eventual adjusted cost basis will be in the event that you do get assigned at some point. In fact, you want to continue rolling your short put or short puts out at the same strike for as long as possible, even if your expiring short put position begins to get a little more in the money or out of the money rather than at or near the money. Here's what I'm getting at. As long as you can continue rolling the position for at least modest net premium, then continue doing so. The idea is to turn on this mechanical put-selling machine and leave it running until it's no longer feasible to do so. And there are basically two ways for it to no longer be feasible to roll for net credits. If the stock is too far out of the money because the underlying stock has risen too much, or if the stock is too deep in the money because the underlying stock has fallen too much. Let's look at those two scenarios one at a time. Scenario number one. If the stock has risen such that continuing to write and or roll new cash secured puts at the same strike price only produces minimal new premium, then pat yourself on the back. You collected a fair chunk of change and you didn't overpay for the stock. In fact, you haven't paid for any stock at all and you're free to move on to the next opportunity. And when you do, and this is important, you should begin to calculate your adjusted cost basis on the new trade, if assigned, so that you include the accumulated net premium you collected during the earlier series of trades. In other words, you're rolling over your accumulated net premium into your next trade or series of trades. Let's suppose, for example, that you collected $4.50 per contract in accumulated net premium on XYZ before the stock traded into the mid-30s and it was no longer practical or remotely profitable to sell or roll any additional cash secured puts on the stock at the original strike price. But now you find an attractive opportunity on that other high-quality stock, ABC, which is trading at $40 a share, and you decide to write a 4-month put at the $40 strike for $1.50 per contract. On an isolated basis, your potential adjusted cost basis, if assigned, would be $38.50 per share. But when you factor in or roll the previous unallocated accumulated net premium of $4.50 per contract from the earlier trades into the new one, your potential cost basis drops all the way down to $34 a share. Here's the math. So we start with the strike price of the new position, that's $40 a share. We subtract the current premium collected of $1.50 per contract. We also track the accumulated net premium carried over from our previous XYZ trade of $4.50 per contract. So we're basically subtracting $6 per contract of total accumulated premium between the two sets of trades. And that gives us an adjusted cost basis, if assigned on ABC, of $34 a share. So you're basically starting your new trade with a huge head start. Now, ideally, you'll also continue racking up more and more net premium so that when you do eventually get assigned, whether that's sooner or later, you're going to have a seriously low adjusted cost basis. In other words, a sweetheart deal. Now, scenario number two is the other scenario that prevents you from rolling your trade for additional net premium, and that's if the stock has fallen too much so that your short put position is incapable of generating a decent net credit. And now, if you've been conservative and disciplined and patient with your trade selection and setups, focusing on only the highest quality companies that are already trading at attractive valuations, hopefully this won't happen too often. But if and when it does, because you've probably collected and accumulated enough net premium from all the preceding trades that you can finally allow yourself to be assigned the shares, you'll still likely have a much lower adjusted cost basis than what the stock is currently trading at. Okay, let's look at the drawbacks to the strategy and what I call the antidote. Alright, I can imagine that you see the drawbacks here. As with a generic put selling approach that involves selling out of the money puts, eventual assignment requires that the underlying stock falls, and not a little bit either. After all, if the stock trades marginally lower, our Sweetheart deal plan calls for us to continue rolling out at the same strike price for continued net premium. But here's the thing about a stock in serious decline. When it's in serious decline, even if we're talking about a high quality operation, the stock often overshoots on the downside. So arguably, as with generic out-of-the-money put selling I described earlier, you could easily have been better off simply waiting and scooping up the shares later on in the open market for an even lower price. Of course, there's a huge assumption with that line of thinking that you've got a crystal ball or other psychic abilities that let you know how low the stock will trade in the first place. And there's another potential drawback as well. If you're writing puts on high-quality stocks trading at cheap valuations, and the only way you get assigned is if those stocks trade even cheaper, well, chances are you're not going to get assigned very often. In other words, the Sweetheart part is in place, but you're lacking the deal part. Fortunately, there's an antidote. And this is where we borrow a page from our sleep at night strategy. When you've accumulated enough net premium income from your repeated trades and conquests, you can simply redeploy or reinvest your gains into open market purchases of your favorite stocks. And you have maximum flexibility here. For example, let's assume you've accumulated $1,000 of net premium income. So you could buy a smaller number of shares funded entirely from your accumulated net premium. Buy $1,000 worth of your favorite stock, whether that's 10 shares, 20 shares, 50 shares, whatever, and you would in effect have an adjusted cost basis of $0. You can also customize your own personal Sweeetheart deal by choosing precisely how few or how many shares you purchase. Keep in mind that the more open market shares you purchase, the smaller your discount's going to be. In fact, you can choose any investment to reinvest the accumulated net premium in. You're not limited to the stocks you wrote puts on, or even stocks at all. You could, for example, use the accumulated premium to subsidize the purchase of bonds, preferred stock, or other income-oriented debt instruments totally unrelated to your earlier trades. Okay, that's the Sweeetheart deal strategy. I know we covered a lot of material in a short amount of time, but I didn't want to turn this into a boring 90-minute webinar. So again, you might want to download the full Sweeetheart Deals special report text version to review the strategy in greater detail. Just click the link below and I'll get you hooked up. In fact, on that same page, there are also other special reports available. So why not click the link below, check them all out, and help yourself to whichever ones you find the most useful. In addition, as a special thank you for downloading any report, I'm also going to give you a free subscription to my daily tips and insights newsletter. I promise I won't use it to always be trying to sell you something. Yes, I let my subscribers know when the Sleep at Night High Yield Option Income course periodically opens up, but most of the time, I'm just sending you more good stuff to help you out. Even the occasional actionable trade idea, such as my no-lose trade idea on T. Rowe Price that I shared with subscribers and which resulted in, I kid you not, a 70.69% annualized return over 17 days. So if you're interested in learning how to use options to generate high-yield income from low-risk stocks, acquire quality stocks at half price or less, or seriously accelerate the dividend growth investing process, then the Daily Tips and Insights newsletter is for you. And of course, you can easily unsubscribe from the newsletter at any time if it turns out not to be your thing. Finally, thanks again for taking the time to check out this video. Hope to hear from you on the other side.